$19 billion. That's how much was liquidated in crypto on the 10th of October. 19 billion. Gone in hours. This surpassed the infamous COVID crash of March 2020, which saw approximately $1.2 billion in liquidations, and the FTX collapse in November 2022, which resulted in around $1.6 billion in wiped out positions. And most of it wasn't because people picked the wrong coin. It's because they used leverage. Leverage is a double-edged sword. It can turn a small move into a big win, or turn a small mistake into a total disaster faster than you can click confirm order. So before you touch that leverage button again, let me show you exactly how traders destroy themselves and how to avoid being the next one. This is not financial advice, always do your own research. Before we talk about the mistakes, we need to understand what leverage actually is, because most traders use it without really knowing how dangerous, truly dangerous it can be. Let's start simple. When you buy Bitcoin, normally on a spot market, you deposit $1,000 and you buy Bitcoin with it. If BTC goes up 10%, your $1,000 becomes $1,100. You made $100 profit. That's a 10% gain. Pretty straightforward, yep? Leverage trading is different. Instead of just using your own $1,000, you borrow money from the exchange. Let's say you deposit $1,000, but you use 5x leverage. Now you're trading with $5,000 total. Your $1,000 is collateral, and the exchange lends you $4,000. Here's the key difference. If Bitcoin goes up 10%, you don't make 10%. You make 50%. Your $1,000 turns into $1,500. But this is critical here. If Bitcoin goes down 10%, your $1,000 becomes $500. You just lost half your money in the same move that would only be a small dent in spot trading. Everything gets multiplied by 5. Profits and losses. That is leverage. Most traders don't blow up on their first trade though. It usually starts simple. A trader wins a trade, feels confident, tastes a bit of success, and they think they've got the edge. Then the next trade comes along. They increase leverage, thinking they can capture the same gains faster. Maybe they even add more margin, telling themselves it's just to secure the position. But when the market moves against them, even slightly, losses start piling up. And instead of stepping back, the impulse is to chase, to win back what was lost. Each loss becomes personal. Each gain feels temporary. Leverage amplifies everything. The emotions, the mistakes, the panic. And that's how you lose your whole account very quickly. The market doesn't care about feelings. It punishes impulses and rewards discipline. When we're talking about leverage, we must also talk about the hidden costs that you might not be aware of. There are funding fees, entry and exit fees, and slippage. I'm going to quickly explain them to you now. First, let's start with the entry and exit fees. When you open a position, the exchange charges you, usually 0.1% per trade. On a $5,000 position, that's $5 just to enter. Then, when you close, another $5 to exit. If you make 10 trades a month, say, that's $100 just in trading fees. Then we have the funding fees. These are small payments between traders. They keep the price of perpetual futures close to the spot price. If you're long and funding is positive, you're paying short traders every 8 hours. But if you're short when funding is positive, you're the one getting paid. On a $5,000 position, funding might be 0.01% per cycle. That's $0.50 every 8 hours. It adds up fast. Hold for a month and you could pay or earn $40 to $50+ depending on which side of the funding you are on. And to top off the list of hidden costs, there's slippage. This is the sneaky one, guys. When you actually buy or sell, you're not getting the exact price you see on the chart. There's a bid-ask spread. On Bitcoin, it's tiny. On altcoins, however, with low liquidity, you can lose 1 to 3% just on execution. You wanted to buy a $50,000 but actually paid $50,750, That's slippage eating your entry. Another mistake people make is the position sizing. Biggest killer is using too much of your account on a single leveraged position. Some people think 2 to 3x leverage is safe, but in the biggest liquidation event, we saw that no one is safe using leverage. All leverage positions got wiped out in a single day. Someone with $10,000 will go all in on one trade with 10x leverage because some guy tweeted it will go up. One bad trade and they are broke. If you're using leverage, it means you shouldn't be risking more than 1 to 2% of your total account per trade. But ego and FOMO make people throw that logic out the window. They also don't account for consecutive losses. If each loss is 5% of your account and you have 3 in a row, you're down 15%. Add one more loss and you're forced into bad decisions or blown up entirely. Speaking of it, when was the last time your overblown ego or FOMO secured you significant wins? Or conversely, has it ever hurt you and your portfolio? Tell us in the comments below and let other people know so that they could possibly learn from your experience and become better traders themselves. So, does all that we said so far mean leverage is always bad? No. Leverage is a tool. Professionals use it every day, but with structure, rules, and respect. They don't use it to get rich quick. They use it to keep more capital free while controlling a larger position, allowing them to diversify and stay flexible. The difference is all in risk management. A pro trader knows exactly how much they can lose before entering a trade, usually 1% or less of their total account per trade. They set stop losses, define targets, and never move these limits on emotion. They also understand position sizing. That $100 trade at 2x leverage might control $200 worth of exposure, but they make sure that even if it goes against them, their account survives. Risk isn't just about leverage. It's about planning for the worst case scenario and acting as if it will happen. If the market goes against them, they lose a little, not everything. That's the key difference, guys. The gambler, on the other hand, goes 10x, 20x, or even higher just to feel something. They chase the thrill of a huge gain, ignore the stop losses, and don't define an exit. Their positions are reactive, I would say, not planned. They hope for the green candle and pray it doesn't flip. So, what should you do if you want to use leverage responsibly? First of all, stick to low leverage, usually 2 to 3x, until you truly understand your strategy. Second, always calculate position size based on your stop loss and account balance. Third, and it's something I still sometimes struggle with, I admit, never trade emotionally. Treat every trade as if it could fail and plan accordingly. And fourth, keep a trading journal to track wins, losses, and mistakes. Reflection is how pro traders improve. Discipline beats excitement every single time. Respect leverage, respect risk, and it can be a powerful tool. Ignore it, and it will take everything from you, faster than you think. You just saw how fast leverage can destroy accounts. And the lesson? Discipline beats luck every time. If you enjoyed this video, let me know by giving it a thumbs up and subscribe to the airdrops.com YouTube channel to continue learning how to stay in the game and not chase the hype. I'm Stan, and I thank you for watching. See ya.